That moment hits hard. Panic sets in. You've worked for decades, and just as you're preparing for your final chapter, the rug gets pulled out from under you. It's not just a job loss, it feels like your entire retirement plan is crumbling. But here's the truth. You have more control than you think. This setback doesn't have to be permanent. The key is timing. What you do in the next few weeks can protect your future for the next few decades. And while the shock is real, a clear-headed plan can turn this disruption into a manageable detour. In this video, I'll walk you through exactly what to do, step by step, to protect your finances, secure healthcare, and preserve your retirement plans. No fluff, just a clear, focused action plan to get you through the storm. Let's start with the first and most critical move, getting organized before panic takes over. Yes, it's a shock, but denial wastes time. Take a breath and face it. Your job is gone, but your future is not. Retirement might be postponed, but it's not canceled. What matters now is action, not fear. Grounding yourself in the reality of the situation is the first way to take control. Start with the basics. Find your final paycheck stub, check for unused vacation payouts, and make sure all benefits were paid. Next, get your severance agreement. Read it line by line. Note any deadlines for accepting or disputing terms. Then gather healthcare paperwork, especially COBRA forms or benefit termination notices. Locate login info for any retirement plans or pensions. Print out current balances. Finally, prep what you need for unemployment: Social Security number, recent work history, and a government-issued ID. Getting all this in one place puts you in the driver's seat for what comes next. Deadlines are now your enemy if ignored. Create a 30-day timeline for urgent items, health insurance decisions, severance acceptance, and unemployment applications. Build out a 90-day calendar for mid-range tasks like budgeting, financial planning, and job search. Use a simple paper or digital checklist to stay on track and reduce mental clutter. Once you've got your foundation set, the next immediate need is cash flow. Let's talk about securing income. Do not wait. Every state now lets you apply for unemployment benefits online. No need to wait in line or mail forms. But here's what they don't tell you. The process can be glitchy and overwhelmed. So apply early in the week, early in the day, and keep screenshots of everything. Here's critical timing. Unemployment benefits never start before the day you apply. Not one day earlier. File immediately after your last day of work, even if you're getting severance. Every day you wait is money you're leaving on the table, and you can't get those missed days back. Keep track of required job search logs or weekly certifications to avoid delays or denials. This income may not be large, but it's critical in the short term. Look at how the payout is structured. A lump sum could bump you into a higher tax bracket. Ask about extended benefits like health coverage or job placement help. If anything is unclear, have a financial advisor or employment lawyer look it over before signing. Understanding your severance fully helps prevent expensive mistakes later. You don't need to replace your full salary, just fill the gap. Look for remote gigs, freelance work, or short contracts that won't jeopardize unemployment benefits. Treat this as temporary cash flow while you plan long-term moves. It's not a step backward, it's a bridge. Put big-ticket purchases and vacation plans on hold. Shift to emergency mode budgeting. Prioritize rent or mortgage, utilities, groceries, and medications. Cut non-essentials. Streaming services, eating out, subscriptions you rarely use. Every dollar now buys you time. Now that you've stabilized your income, the next major issue is staying insured. COBRA lets you keep your exact same health plan, but now you pay the full premium. What both you and your employer use to split, plus a 2% administrative fee. So if your employer was covering 80% before, your COBRA bill just became 5 times higher overnight. It's expensive, but there's no gap in coverage. COBRA typically lasts 18 months after job loss, but can extend to 29 months if you become disabled, or up to 36 months for certain family events like divorce. The clock starts ticking from your termination date, not when you elect coverage, so don't delay the decision. If continuity is your top priority, this is often the cleanest option. The Affordable Care Act may offer cheaper plans based on your new lower income. In some cases, subsidies can cut premiums significantly. Compare plans for deductibles, networks, and medication coverage. If cost matters more than plan familiarity, the ACA can offer serious savings. If your spouse has insurance, ask if you can join. Act fast. Employer-sponsored plans usually give 30 days after a life event like job loss. Get the full cost and coverage details before switching. This could be the simplest and most affordable route if available. You have 60 days to elect COBRA coverage. The ACA special enrollment window also opens for 60 days post-job loss. Miss those windows, and you risk going uninsured for months. Now that you've secured your health, let's focus on your long-term financial base, your retirement savings. Avoid the temptation to dip into retirement early. Touch your 401k before age 59 and a half, and the IRS hits you with a 10% early withdrawal penalty on top of regular income taxes. There are some exceptions, like certain hardships or if you're 55 and leaving your job, but those are narrow. The real killer isn't just the penalty, it's destroying decades of compound growth you'll never get back. You work too hard to let short-term pressure erase long-term value? If you leave your job, you can roll your 401k into an IRA. IRAs often offer more investment options and lower fees. If you take cash directly from your 401k instead of rolling it over, your employer must withhold 20% for taxes automatically, even if you don't owe that much. Roll it directly to an IRA instead, and you avoid this forced withholding and keep control of your money. It's a simple move that protects flexibility and avoids red tape. You can access retirement funds without penalty, but taxes still apply. Only withdraw what's absolutely necessary to cover urgent needs. If you're in a lower tax bracket now, consider converting some to a Roth IRA. A strategic drawdown can reduce future taxes without damaging your savings. Update your retirement age based on your new reality. Adjust your income needs. Maybe you work part-time longer or move to a lower-cost area. Preserve your savings where you can. Delay withdrawals and stretch your assets. With your savings protected, it's time to rewire your full retirement strategy. Build a new budget from scratch. Use your new income or lack of it as the base. Include COBRA or ACA premiums, job search expenses, and a buffer for emergencies. Plan for inflation on fixed expenses like food and utilities. Your spending plan must now match your post-layoff reality. It may be time to rebalance your portfolio. Shift from aggressive growth stocks to safer, income-generating investments like dividend stocks or bonds. Avoid speculation. Now is not the time to chase big returns. Preserve your nest egg while squeezing out steady income. Here's the math that matters. If you can delay taking Social Security past your full retirement age, that's around 66 or 67 depending when you were born, you earn delayed retirement credits of 8% per year until age 70. That's guaranteed growth you can't get anywhere else. Taking benefits at 62 versus waiting until 70 can mean the difference between getting 75% of your benefit versus 132%. That's nearly double the monthly income for life. Bridge the gap with savings or part-time work if you can. Even 1 year of delay can significantly improve long-term stability. Plug in your new numbers. How much you have when you might retire, and how much you need. Test different scenarios. Retiring at 62 versus 65, taking Social Security now versus later. See the long-term impact of short-term decisions. And while planning is powerful, don't forget to guard your credit as you adjust. Call your mortgage company, car lender, and credit card issuers. Ask about hardship options. Many offer forbearance or reduced payments. Document every agreement and confirmation number. Silence leads to penalties. Communication leads to cooperation. Missing even one payment can seriously damage your credit score, potentially dropping it 60 to 110 points depending on how high it was to start. If you've got excellent credit, the fall hurts more. But here's the key. The damage compounds fast, so protect that score like your financial life depends on it, because it does. Set up autopay for minimums if you're worried about forgetting. Keep your score intact for future loan access if needed. Credit is a lifeline in retirement. Don't lose it now. Only borrow if absolutely critical. Medical bills, essential home repairs. Don't use credit to maintain appearances or lifestyle. This is about survival, not appearances. Use 0% APR credit card transfers carefully to reduce high-interest debt. Personal loans can help consolidate balances but don't solve spending problems. Don't apply for too many new lines at once, it hurts your credit. As you protect your financial foundation, don't isolate. Your network matters more than ever. Send a simple message to trusted former coworkers or managers. Let them know you're open to opportunities or referrals. Update your LinkedIn profile with a clear, current headline. People can't help you if they don't know you're looking. Some employers are more open to experienced workers. AARP and nonprofit job boards often list part-time or flexible work. Consulting, tutoring, or seasonal jobs can provide income without long-term commitment. These aren't career moves, they're cash flow and confidence boosters. Avoid any job offer that asks for upfront fees. Be suspicious of interviews on chat apps or generic job postings with vague titles. Never give out your social security number or bank info to unknown sources. Desperation makes you a target. Stay sharp and stay skeptical. This isn't the retirement ending you expected, but it's not the end. Think of it as a reset, a chance to reconfigure. Many people retire well even after a layoff because they responded strategically. And now you're doing the same. You don't need to figure everything out today. Avoid fear-based choices, especially with money. Move steadily, not impulsively. Let reason lead, not panic. You've built skills, a career, a work ethic. Those things don't disappear with a layoff. Now it's about protecting what you've earned and planning your next steps smartly. Retirement is still on the table. You're just getting there a different way. We cover topics just like this: retirement planning, layoffs, Medicare, and how to protect your money in uncertain times. If you like this video and would like to watch more, hit the subscribe button, hit like, and turn on notifications. More retirement tips and real-world strategies are on the way. Stay smart, stay steady, and stay in control of your future. We'll see you in the next video.